Hey everyone, and welcome to our explainer from the Wealth and Compliance Academy. You know, in compliance, we spend a massive amount of time and energy getting a new customer onboarded. But what happens after that welcome email is sent? Well, today, we're diving deep into the rest of the Know Your Customer lifecycle. This is the crucial, ongoing work that protects your institution long after that initial sign-up. Let's get right into it.
This right here, this is the single most important concept we're going to talk about. Onboarding is just the starting line. Real, effective KYC is this continuous loop of vigilance and monitoring that keeps both the customer and the financial institution safe. Think of it as a journey, not a one-time event.
Right, so the account is open, the customer is all set up and happy, but for a compliance pro, the work is really just getting started. The big question we always have to ask is, how do we make sure that a customer who was low risk yesterday is still low risk today? And that's where ongoing monitoring kicks in, starting with some routine checkups. The easiest way to think about periodic reviews is like a scheduled health check for your customer relationship. These aren't random at all. They are planned, regular check-ins designed to make sure all the information you have on file is still accurate and that a customer's risk profile hasn't quietly drifted into new territory.
And this is way more than just, confirming an address. The key word here is reevaluation. A customer situation is never static, right? Businesses grow, ownership structures change, they might expand into new countries. A periodic review is the formal process to capture all those changes, making sure your risk assessment reflects who that customer is today, not who they were 2 or 3 years ago when they first signed up.
And let's be totally clear. This is so much more than just ticking a box for compliance. I mean, yes, regulators absolutely demand it. But more importantly, this is just smart, proactive risk management. These reviews are your chance to spot a subtle change in a customer's business that could signal a new risk or maybe identify transaction patterns that just don't quite add up. It is your first line of defense against being caught completely off guard.
Of course, you're not going to treat every single customer the same way. That just wouldn't make sense. And this table shows that risk-based approach in action. Your team's time and resources are limited, so you have to focus them where the risk is highest. So, a high-risk client, maybe a politically exposed person or a company in a risky industry, they're getting a deep dive review every single year. But a stable, low-risk local business, they might only need to check in every 3 years. It's all about being smart and proportional with your efforts.
But what happens when you can't wait for that scheduled review? I mean, what if something big happens tomorrow? Sometimes an event pops up that acts as a huge red flag, forcing you to take action immediately. And this is exactly where event-driven reviews come into play.
So, unlike that planned periodic review we just talked about, this is completely reactive. Think of it like pulling the emergency brake on a train. Some kind of trigger event has happened that forces you to drop what you're doing and reassess that customer's risk profile right now. It's an absolutely critical tool for tackling emerging threats in real time.
So what kind of triggers are we talking about? Well, it could be a news alert that pops up about your client's involvement in a scandal, or maybe your monitoring system flags that they've suddenly started doing business in a sanctioned country. A new majority shareholder with a, let's say, questionable past, that is a massive trigger. Each one of these events can fundamentally change the entire risk equation and demands an immediate response from your team.
Okay, theory is great, but let's make this super practical. We're going to walk through a quick case study to see exactly how an event-driven review unfolds, from that first little red flag all the way to the final decision.
Okay, so let's picture our customer. It's a standard, medium-risk company. We onboarded them 2 years back, everything checked out perfectly, and honestly, they've been a pretty solid client. Their next scheduled periodic review isn't even due for another year. On the surface, everything looks totally fine. And then, the trigger hits. An automated monitoring system sends an alert to an analyst. Our company has just opened a big new subsidiary in a country that's on the FATF gray list. Whoa, okay, this is a material change. An event-driven review is triggered on the spot because their geographic risk profile is just shot through the roof.
Now, running these reviews isn't always a walk in the park. The biggest challenge is often just detecting the event in time, which is exactly why those automated systems are so incredibly valuable. These investigations can also eat up a lot of resources. And, asking a good customer for a bunch of extra documents can create some friction. The key to making it work is clear, transparent communication, just explaining why you need the information.
So, you've done the deep dive, you've completed the event-driven review, and you've reassessed the risk. But what if that risk is now just too high? What if it's something you can't mitigate? Sometimes the only responsible decision is to actually end the relationship, and this process is called offboarding.
So, back to our case study. The review kicked off a full enhanced due diligence investigation, and what it found was not good. The ownership structure of that new subsidiary is intentionally confusing and opaque. Plus, the transactions flowing through it don't match what the company says it's doing. The compliance team tries to get clarity but gets nowhere. The risk is now deemed unacceptable. The decision is made. It's time to offboard.
Now, it is so important to understand that offboarding is not just closing an account. It's a formal, structured risk management procedure. It requires a crystal clear rationale, a documented audit trail, and a very controlled process to sever ties while protecting your institution from any more risk.
So why is this formal process so vital? Well, first, and most obviously, you mitigate risk by cutting off the threat. Second, you demonstrate to regulators that you have a robust, defensible framework for dealing with high-risk clients. And third, you protect your institution's reputation. Believe me, the last thing you ever want is your company's name in a news headline next to a client involved in financial crime.
A proper offboarding really follows 4 key steps. 1. Review all the findings and document the final reason for the decision. 2. Communicate professionally and formally with the customer. 3. Close out the accounts in a controlled, orderly way. And 4. The absolutely critical final step, report. This means finishing all internal documentation and, if the activity warrants it, filing a suspicious activity report.
Okay, we have covered a ton of ground, so now let's lock in all this knowledge with the 7 most important points you need to remember from all this. Think of these as your essential exam takeaways for this whole part of the KYC lifecycle. If you can master these 7 points, you'll have a rock-solid grasp of ongoing due diligence.
All right, number 1, KYC is a continuous life cycle, not a one-and-done event. 2, periodic reviews are your proactive health checks, and they're always based on risk. 3, event-driven reviews are reactive, like an alarm bell, triggered by significant changes. And 4, you've got to know your key triggers, like adverse media, a change in ownership, sanctions hits, or PEP status.
Number 5, any review has one of 3 outcomes: continue as is, add more controls, or offboard. 6, remember that offboarding isn't a failure, it's a critical risk management shield that protects your institution. And finally, number 7, and I cannot stress this enough, document everything, meticulously. In the world of compliance, if you didn't write it down, it never happened.
Understanding the full KYC lifecycle beyond just onboarding is absolutely fundamental for any compliance professional. I really hope this explainer has helped make these crucial stages a lot clearer. To keep going with your studies, make sure to check out the full playlist for this chapter. Thanks so much for watching.